Good evening, everyone. Welcome to Easy Credit Building. Best credit, how to win the credit game. Like I always do with R&B Wealth Strategy, I start my presentations with a prayer. I thank God for this amazing day, for allowing us to be here, for allowing us to be together under one same purpose and one same vision. Father, thank you so much for giving us the opportunity to be able to help others. I thank you, Father, for my leadership. I thank you, Father, for my leadership team, the millionaires in the making. I thank you, Father, for continuing to open doors. And I also thank you, Father, for those doors that you close. I receive it and I thank you. Bless their family, those that are on their way. I thank you, Father. I ask you to give Mr. Young wisdom, knowledge to be able to speak and to be able to transmit all of that hard work that he has put over the years. I thank you, Father, for this amazing opportunity. I thank you, Father, for this day. I thank you, Father, for the sun, for the rain. I thank you, Father, for everything. In Jesus' name, I heal it and I close it. And I say, amen. With that being said, welcome to R&B Wealth Strategy Network. We present Easy Credit Building. Mr. Young has worked very, very hard all weekend, by the way, all week, putting this together. Mr. Jack Laban, thank you so much for proofreading. If we have missed anything, it's okay. Take the concept. We'll make it happen. Thank you so much for your help, for your support. I love you. Without being here, because I'm not your host, I'm so sorry. I'm not going to keep you alive. It's Mr. Young. Here it is, live in person. I love you. Here we go, teddy bear. Make it happen.
Hey, good evening, everybody. I appreciate everybody for hopping on here tonight. It is definitely going to be an eventful evening. You're going to learn not only a lot about credit, but these are basically the stipulations that a person needs to be able to qualify not only for our financing, but even to qualify for other forms of financing with banks, credit cards, so on and so forth, because they all kind of do go hand in hand. There's just a little bit of difference in between the two, okay? So this is like knowledge that you'll be able to utilize for this business, for yourself, for your clients, for your children, for your family, I mean, on and on down the line, because it's not going to stop here. There's a lot more that I am working on for you guys, because we want all of our agents to be prosperous. We want you to be successful. We want you to make a lot of money. Okay, I made a post on Facebook maybe a week or two ago about how we were going to have our first millionaire on our company before another company, which I ain't gonna say no names, but we know that they are definitely watching us, and they have been around a lot longer than us, and it does nothing but fuel our drive, okay? Because I learned it a long time ago. If you want to know the size of person you are, what kind of person you are, size up your enemies. You size up your enemies. If you got big enemies, then you're a big person. I promise you. All right. A lot of you don't even know that my background is in credit funding and business credit. Okay, but business credit is another topic. This is just personal credit. Okay, when it comes to personal credit, what I did was funding for personal credit. Okay, that was before we even dived into the financing side. So this is like one of my main go-tos. It's where I got my start at. I thank God that this is where I got my start at, because it helps me to do financing a lot better. Because once you know where a person stands in their credit, you know where they'll stand when it comes to financing. Of course, you have to look at their credit file and so on and so forth. But once you know what you're looking for, it's a big difference, okay? I made a lot of money doing this. I made a lot of other people a lot of money. Okay. I would have made even a lot more money, but I was kind of just a little too generous back then. And, I gave away a lot of things. I helped out a lot of people. I didn't charge people the way I should have been charging them. They got hundreds of thousands of dollars, and then maybe I only got 1,000 or two, or maybe even nothing sometimes. Okay. So there are people that have started businesses off of me. There are people that have made investments because of me, flipped their first homes because of me. Okay. That's not to raise myself up and put myself on a pedestal, because that's not what I do, but I know my worth. I know my value, and I know exactly what it is that we are going to be offering tonight. And the real truth about it is that this is kind of basic. For me, it will be basic. For you guys, it will be kind of eye-opener to a lot of different things, okay? So I want you guys to be prepared. I want you guys to have your pencils out, soak it up. This is definitely something you want to pay attention to. All right. I'm not the type to waste time. I like to give information, and this is one of my passions. So I want to get into it. All right. Real quick. This is kind of basic and simple, and a lot of you know this. All right, but it's the beginning to our presentation, and some people don't know it. All right, so you have to pay attention and understand what is actually making up your credit score, what is making up your credit report. Okay, the first one we got is your payment history, which is obviously the biggest. All right, it makes up 35% of your score. All right. Now, from a standpoint of 1 to 100 is what we're working off of, but we all know that your score can typically go up to an 850. It's hard, very hard to get up to an 850 because it takes time, it takes a lot of energy, it takes a lot of accounts, and it's not just something that you're going to get overnight. All right. Don't even think that that's not a bad situation for you if you're not at an 850, because typically as long as you're doing a 680 score or better, you're doing really good. Once you crack into the 700 scores, above 720, okay, the sky's the limit for you. Okay, but 35% of your score boils down to your payment history. Okay, this is your account payment information. It lets the creditors know if you are delinquent with your payment history. It shows how long you've had your accounts, and this is typically one of the things that will really matter. Okay, when people are complaining about not being able to get credit, okay, this is the portion that they're looking at, the history. What have you got? What have you done? Who's extended you any lines of credit before? Oh, you don't have anything? Oh, okay, well, sorry for you. We're not going to be the first ones to extend you any lines of credit. And then you're boo-hooing because nobody gave you no play. All right? You have to have history. You have to show where you've been, what you've done, and your responsibility with what you've had. That's what they're looking for. That is what payment history boils down to. All right. Also, the amounts owed. All right. Now, when we're talking about the utilization, this is what we are talking about. Your revolving credit, your installments, and even some other accounts that are on there, like student loans, so on and so forth. But really, when it comes down to like getting a person financed, it will typically boil down to your revolving accounts. Loans and other things play a portion in there, but it's your revolving. And you have a lot more control over that. If you can drive down your revolving accounts and how much you're utilizing, it will make a big difference when it comes time to be able to do financing. All right. This makes up 30% of your score. So also the amounts that you owe on your different accounts make a very big difference within the credit decision. We already talked about the history, which is 35%. Now we're in how much you owe on your revolving and your installment accounts. That makes up 30%. So just think about it real quick. Just alone, that's 65% of your score. Okay, so guess what? That means that these are two of the main portions, the main factors that make up your credit file you need to really pay attention to. You really need to pay attention to it. What have you had on your file? How much do you owe on your file? That is going to make a big difference when it comes to the financing. I hate to say it again, but I have to. I have to reiterate it because it's very important. All right. Now, the amounts that you owe onto your file not only make up the credit decision, okay, but it makes up the utilization. When you look on there, and you've heard it before saying that you should be able to keep your keep your utilization below 30%. That is why, because once it goes up above 30%, guess what? Your scores are going down. That's just the way it is, especially for personal. Business is different. Like I said, this is not business, this is personal. But once you go above 30% of your utilization, okay, your scores will start to go down. So let's say you had a $10,000 credit card. Once you use $3,000 of that, guess what? It's starting to go down. Your points will start to plummet. And the farther you go up in your utilization, the farther it will go down. So when you're talking to your clients, okay, and not only for your clients, but also for you, if you ever do any financing in the future, you want your utilization to be below 30%. The more you are below 30%, the better odds you have. 30% is like just the threshold to break even. Once you cross over that, that's when things start to happen and your scores go down. Once you get under 30%, that's when your scores start to go up. That's when lenders look at you like, okay, you're not that thirsty, and we can take a chance on giving you a little bit of money because you're not using up everything that you already have access to. That's something else that's just a part of the credit game, okay? When you utilize up what you have, they look at you like you're a risk. Once you show that you're barely even using what you have access to, they're like, okay, we want to give them some more, because now they want to be the ones that you are owing money to, so they can make money off you as well. Okay. Also, the length of credit history. All right. This makes up 15% of your score. Now, some of you have talked to me before, and I've let you know before that typically what lenders and banks are looking for in a perfect credit file when it comes to length of credit history is 10 years. 10 years or better. Oh my God, Richard, this is 10 years. I just got a credit card just a year or two ago. Okay, I said the perfect. That's the perfection, is 10 years of history that they can look back on, and they can see you've had access to this account, you've paid this one off, you've paid this one on time, you're currently paying this one on time, so on and so forth. And then they're like, okay, this is a person that's very responsible. He's shown what he can do, or she can do, over 10 years of time. So that makes them feel better, and they'll extend you. Jesus, I've gotten so much credit just because of the 10-year history that I was able to add to my file. It was like ridiculous. But anyways, when it comes to the credit history, okay, 10 years is the perfection. But for us, even if a person only has about I don't want to go lower than a year, because sometimes you can have 6 months and you'll still get financed, but it will be like kibbles and bits. It'll barely be anything. You might get a few thousand, okay? The closer you get to around 2 and 3 years, now they're like, okay, we can extend this person credit based off of also his income and the other factors that are on your file. But if your credit history, your length of history is really shallow, you could have a great score. You could have great information that is on your file, but because you haven't shown over a length of time that you're able to manage a certain amount of money, you could even get denials for that. Okay. Now, it doesn't make up too big of a percentage when it comes down to it. It's only 15%, but still, at the same time, it's still a factor, okay? And you could just think about it for yourself, all right? If you're dealing with a person and you want to loan them some money and it's like, bro, you just like turned 18 yesterday. You've never even had a job. I've never seen you manage money before in your life. Do I really want to be the first one that takes a chance on giving you some type of money? No, I don't. We don't. We might do it because we're generous or because the kindness of our heart, but we don't want to do it because they haven't proven themselves yet. Okay. Also, types of credit used. Now, this is a mix of revolving and installment accounts. You need this. I have to stress this point also because it is a factor. You need this. You need revolving accounts and you need installment accounts. If a person has a couple revolving and at least one installment account on their file when they get ready to do financing of any kind, whether it's with us or with someone else, they have a better chance of getting approved. If all you have is a whole lot of installment accounts, it's like, okay, where's this revolving? We don't know what he's doing with money that he has access to every day that could fluctuate. Okay, the same thing in reverse. If he has a whole lot of revolving and he's never had an installment, okay, it's like, well, what does this person do with a lump sum of money? Because typically installment accounts are your largest ones. They go larger than revolving. Revolving can get pretty large. I mean, you can run into people that have $10,000 credit cards, 30, 40, $50,000 credit cards. Okay, but think about the amount of money that you can get on installments. Installments can go pretty high. We're talking about loans. We're talking about car loans. We're talking about even mortgages when it comes to that. Okay, so think about how high some people can get finance for a mortgage. We're talking about $250,000, $500,000, $1 million. All right, so installments will be the largest. So you don't need as many installments as you do as for revolving, but if you have at least one good installment, it will level out with the couple of revolvings that you have. Okay. Also, new credit. New credit makes up 10%. All right. Once again, it's a small percentage, but it is still a factor. All right. So think about it in terms like this with new credit. All right. New credit can do a few different things when it boils down to it. All right. New credit can boost your scores, or it can bring your scores down. And typically, if you just got finance, people aren't really worried about their scores going down a little bit. It's kind of expected, okay? And then later on, your scores will go back up over time, all right? That's what new credit does. It can boost your scores or it can bring it down. If you've gotten a lot of new credit, it'll bring your scores down, and also what it will do is it'll restrict your access to further financing, and typically that works within at least like a 6-month time frame. Okay, so if you got just today like a few different accounts from a few different lenders, not only is your scores going to go down, but at the same time, other lenders that might be looking to extend you some type of financing, they're now going to start to back up. Those other guys just gave you money, but the new guys are going to start to back up because they're like, okay, he just got a loan from X, Y, and Z, and then he got another one from A and B, and then he got another big one from C and D, you know, so it's like, all right, he's already racked up a lot of money. Let's not overextend him because he might pay the other guys back, but he might not pay us back. Okay. New credit is great. You need new credit to pop up onto your files, but at the same time, when it comes up, it's going to bring those inquiries and it's going to show that you just got new lines of credit, new types of funding. So other financiers won't want to touch you for a while until they can see exactly what you've done with that financing that you just received. Okay, so in 6 months, you can typically revisit some new type of financing after you've already put a little bit of history behind those inquiries that you just racked up. Okay, that's very important. You probably never even heard it explained like this. Okay, These factors, these 5 factors that make up your credit, all right, are very important. You have to understand the payment history. You have to understand the amounts owed. You have to understand the length of credit history, types of credit, and new credit, okay? So I hope you guys are paying attention to this one, because sometimes we get people that come in and they want to get financing, and they typically don't even understand why they got approved or even why they got denied. Here's your answer. Just in this one slide alone, there's your answer, okay? I'm not going to spend too much time on it because you guys kind of got the understanding behind that one. Excuse me. Now, what do you need on your credit to get financed? All right? This is the one question that I've never even received from anyone. People, they'll complain up and down all day long on why they didn't get financed, or they think that they know what is on their file. Oh, I just got, a credit card from Capital One yesterday. They approved me. Okay, what else do you got on your file? Oh, that's it? Oh, okay. Well, that's why. There's a multitude of different reasons why a person can get financed or denied. And the denial part, we'll get to that later on in the presentation. But, okay, let's dive into it. I kind of explained a little bit about the history on the other slide, on what they want to see in a healthy credit file as far as history. But also, along with that history, typically, creditors want to see in a perfect file 20 plus trade lines, okay? Now you're thinking, what are trade lines? Trade lines are basically just accounts that are on your file. That's all they are. That's it. If you want to understand what a trade line is, look at your own credit report. You got a Capital One card? That's a trade line. That is an account that is reporting to your file, and it is showing the line of credit that you got, and it's showing the history, it's showing your positive payments, and it is showing the amount. It is showing the utilization. That's a trade line. That's all a trade line is, okay? And if it is on your file and it's in your name, that's a primary trade line, all right? So what they want to see is 20 plus trade lines. But just to get financed, okay, all you really need is 4 to 5, okay, to secure financing. And a lot of our agents that are on the line, I don't know if there's some new people, but our agents understand from the training that they have been getting in our private Facebook group, in the personal, the unsecured loan personal loan video, that is the same thing that's in there. They need the 4 to 5 accounts on their file, okay? You have to have it. 4 to 5 is the bare minimum, okay? We're still able to get some people financed when it boils down to it with just that. But when you're thinking about a great credit file, you want to have 20 plus trade lines. So even if you get some clients and they're somewhere in between 5 and 20 trade lines on their file, okay, you're working with somebody. This is a person that's had a little bit of history. They've had access to some money, okay? Then you dive into how they've utilized it, all right? But that's an entirely different story there. But this is what you need on your file, just the first one. You need at least 4 to 5 trade lines on your account, okay? Now, some of you that don't got any credit, don't know how to build credit, keep getting denials when it comes to credit. It's like, okay, well, how do I get those trade lines in order for me to get financed? Okay, it's simple, okay? You apply for lines of credit, loans, secured or unsecured cards, in-store credit, okay, or auto loans, all right? Now, if you barely have any credit, some of those that you see up there, you won't qualify for. The lines of credit, more than likely, you're not going to qualify for. The loans, you're not going to qualify for. But guess what? You can do a secure card at your bank. You'll qualify for that. That'll pop up as a trade line. You can do some unsecured cards that are for people that want to build their credit. There's a couple out there like that. And I'm going to provide you guys with some of that information as well. Okay, you can do some in-store lines of credit. Okay, now I'm not talking about when you walk into the Macy's and then they offer you the credit and then they run your credit. Okay, those are the ones you want to stay away from. You want to stay away from those, especially if you don't got no credit and you don't even know how the story is going to go, and you never were even really planning on trying to get a Macy's card. All you're doing is letting them put an inquiry onto your file. Don't do that. All right. Now, the auto loans, it's not too hard to really get an auto loan. But if you've never had anything, more than likely you're not going to get an auto loan. Okay. An auto loan is one of the easiest ones to get, whether you get a high interest or a low one. But if you don't have any credit on your file, you're probably not going to get that. Okay. But that doesn't mean that it's over, because like I said, you can do secured cards, and there are some unsecured cards that you can qualify for, and there are a couple in-store lines of credit that you can qualify for. And once you have 4 to 5 of those onto your file, now you're building credit. Now you're developing a score. You're also developing a history. And if you don't utilize them to the max and burn them out, you will do great. You keep your utilization low. If you use it at all, well, actually, you do have to use it because they want to see utilization. So I can't even say that. If you have any type of in-store cards or a secure card or even an unsecured card that is meant for credit building, you want to utilize it just a little bit, and pay it back. And then utilize it just a little bit and then pay it back. So you can show that activity. All right. That's what they want to see. How are you using what you have access to? What is your responsibility? Okay. Now, the thing is like I was diving into, what if you can't get any of the above ones, specifically ones that you typically want when you're walking into a store, or an auto loan, or a specific loan for personal or even business needs? Okay, this is one of the main things that you could do. Become an authorized user on someone else's credit. Become an authorized user on someone else's credit. All right, that's great. I am a big fan of trade lines. I don't know anything about these other guys that look at trade lines like they're just so terrible, when they're not. And a lot of them have done trade lines, but they don't want to tell you that they've done trade lines. They don't want to say that their wife had great credit and she added him to a couple of her credit lines, and that's how his score boosted up, and then he was able to get his credit cards and his car and so on and so forth. Okay, that's hogwash. Get you an authorized user if possible. Okay, if you have a family member, dad, mom, sister, cousin, whoever, as long as they got great credit and their stuff's not maxed out and they have negative information that is going to bleed over to your file, I would say do it. Okay, and just to reiterate a little bit kind of what I just said, if you do an authorized user with somebody else, which is basically piggybacking, you don't want to hop on somebody else's card that has bad credit. Don't do it, because typically what's going to happen is their information for that specific trade line is going to now bleed over to your credit file, and it's going to leave a negative stain on your credit file, which is just going to hurt your process. Okay, so before you do a trade line with somebody, don't be like, hey, Rich, I was listening to you. I got on this guy's credit card and it was just all bad, man. Okay, listen, when you do this stuff, all right, don't get onto somebody else's card and they have negative information on that trade line. They are not even paying their payments on time, and their utilization is just through the roof. Okay, it's better to just leave your credit the way it is. All right. Also, another thing that you can do, you can purchase credit building accounts. Okay, and we kind of spoke about that a little bit already. Doing secured cards, getting an in-store line of credit, or even getting a secured loan. Secured loans are really slept on, and they can make a big difference onto your file. Okay, and all you have to do with that is deposit at least about a good $500. Sometimes some places can go as low as even $300, but let's say $300 to $500 into an account. Take out a secured loan on that amount, and it'll show up onto your credit file. Make your payments on time for it. Even pay it off early. If they give you 6 months to pay it back in 90 days. Great. Not only does it show that you paid it off early, but you paid it off, so now it's a positive trade line on your file. It reflects that you were responsible with what you were given, and you're on your way to building credit. So there are ways to do it if you don't have any credit now. That's fine. You might have to take the baby steps. Those are the baby steps. You have to start somewhere. We all did it. I did it. I remember when I was doing the exact same thing, getting in-store lines of credit, getting secured loans, getting unsecured cards that were meant for me just to build my credit. I had to do what I was supposed to do with it, paid it back. I moved money in and out of it real quick, just buying bubble gum here or paying for some gas here and there, paying it off. And then it slowly built my score, and it built the trade lines onto my file. And then I moved up, and then I was able to start securing, $5,000 cards, $7,000, and then it really went up 10, 15,000, and then I was getting $25,000 lines of credit here and there. I mean, it gets real ridiculous after a while once you do the right thing. That's all you have to do. And it all starts from the beginning. Everything starts out as a seed, and then it grows to be a big old tree out in the wilderness as long as you do what's right. We'll be able to provide a PDF, okay, that'll have some of this credit information in it, so you guys aren't left out in the wind. You're like, where do I go to get this stuff? Some of you know a little bit, some of you don't. But we're going to make sure that you have access to that information. Also, these are some of the other things that you need onto your credit, okay? Positive history from revolving credit and installment accounts. We already touched on that. No, student loans do not count. Okay, so if you've had student loans going back to the 90s and you're like, hey, I got over 20 years of history, that don't count. That don't count. But I got $60,000 in student loans. Okay, that don't count. That don't count. It's a totally different history. It's a totally different story when it comes to it. And without getting all technical and trying to figure out the ins and outs and woo-wap-de-wham when it comes down to it, just know student loans don't count. So don't count on it. All right. If you have some history that is on your file that reflects like, okay, that you've had student loans for the last 20 years, but you really only had real credit, revolving and installment loans for the last 5 years, then you know that really you only have 5 years worth of history. And the lenders know that, and the banks know that. So there's no sense in even arguing that fact. Okay, you really only got about 5 years worth of history. Okay, you need primary accounts, not just authorized users. Okay, so you can't just hop on to cousin Freddie and your mom's card and your dad's card, and and you've been added as an authorized user for like the last umpteen months or a year or two, and think that that's all you need to be able to secure financing. Nope. They also know that too, because it pops up on your credit file as an authorized user. Okay, so they know it's an authorized user. It helps you when you have other accounts on there. It'll boost your scores, and it'll show that you have access to other financing, and it'll play a really big factor when you're ready to get especially like credit cards and lines of credit. It really helps for that, but you need those primary accounts to go with it. So you can't just do authorized user. You need cards that are in your name, in-store lines of credit that are in your name, secured loans or secure cards that are in your name. Okay, also you need to show activity on your credit lines. All right, that kind of boils down to something else that I touched to already before. You have to show that you're using it. You have to. You can't just get a credit card. You can't just get a $5,000 credit card and just let it sit on your file. That doesn't spell out to the banks or the lenders that you know how to be responsible with what you have access to. Utilizing that $5,000 and paying it back on time and being responsible shows that you know what you're doing. And that spells out to them that this is a person that we should extend further lines of credit to. Okay, so you have to have activity on your lines of credit. And even sometimes if you go too long without utilizing it, those accounts can get shut down. Why? I don't know. They have their reasons, okay, especially for revolving. You can go a certain amount of time, never use a card, and then one day you just get an email saying that your account has been shut down. It can happen. I've seen it, all right? Just be aware of it. Also, no negative information. No negative information, or at least 2 to 3 years old from the date of the time that you had that negative info on your file. Okay, that is typically what is needed to be seen on your file, especially if you're trying to do financing. You don't want to have negative information, but if you do, it has to at least be 2 to 3 years old. And on top of it, there has to be some type of positive information, okay, that you've been building onto your file after that. Okay, so this is for some people that have been asking the question, or if you've never asked it and you've just been thinking about it. A person has like a bankruptcy, just for instance, and after that bankruptcy, they've done nothing at all. And then 2 to 3 years go by, and then now they just decide, hey, I want a loan. No. You might find somebody. I mean, hey, stipulations do change, but to my knowledge, and I stay current with the information in this industry, nobody's going to extend you nothing. Why? Because you haven't done nothing in the last 2 years. They don't know if you're going to do the exact same thing that you did 2, 3 years ago with what you're asking for. Okay, so you have to show some positive history after you've had that negative information on your file. Okay, one thing that you guys can do, you can follow us on social media. Excuse me. You guys can go on to our Facebook business page. We're always providing information on there. We're always giving out good tips, new info about the industry or about credit, and you can keep up on new information to help you out in addition to what we're providing here. And also even follow us on YouTube. Subscribe. Go on there. Like it. Follow everything that we're doing on there. Soak up the information. It's great information. Info is on there about different types of financing that we don't even offer because we've decided to take it off of the table because it is just too hard of a process in order for us to do it for our clients right now. Okay, but it is information that you can use for yourself to build your own credit, to get your own financing, especially with the business credit videos that we have on there. But also you'll know the ins and outs of how to get financed with us from looking at some of the videos on there, so you know exactly what is required. Now, your debt to income ratio. All right, this is something that's not going to show up on your credit report, okay, but it is a factor. Just like your credit score, your history, your new credit, the inquiries, so on and so forth, everything that we just talked about is a factor when it comes to getting a person financed. Your debt to income ratio is also another factor, okay. This basically spells out to the lender what you are doing, where is your money going, how much you have access to, and what are you doing with what you have access to. Are you overextended? Are you spending too much money? Are you, by their standards, in good standing when it comes to your debt to income ratio? Okay, so real quick, the debt to income ratio is not part of your credit score because your income does not appear on your consumer report. We talked about that. However, many lenders will ask about your earnings on the new account application and use your debt to income ratio in combination with your credit score to make an underwriting decision. Hey, that what we just talked about? That's exactly what they do. So don't think that what you make is not a factor just because you got you a 700 score and you got some great history on your file, and then you work at McDonald's, and then you got a $2,000 house payment and a $500 car note. It doesn't work. That doesn't work. That doesn't spell out that this is a person that will be able to pay us back if we extended them some money. Okay. Also, your amount of installment loan debt affects your debt to income much more than your amount of revolving debt. Okay. Sad, but true. All right. Now, because of the fixed monthly payment amounts, revolving debt gives you more wiggle room. Your calculation, all right, when it comes to your debt to income ratio, by totaling all your monthly payments and dividing by your monthly income, is what's going to make up what your DTI is. Okay, and basically that's the front end and the back end. That's just industry talk right there. Okay, so basically when it comes to your front end and your back end, when your front end amount, okay, When your front end amount is over 25%, you're going too high. You're going too high in how much you're spending out every day. That's just what it is. I'm sorry to say it, but they start to see that they feel like you're utilizing too much of the finances that you have access to. Okay, they want to see that your payments are below 25% of your DTI. All right, so that shows that you're actually saving money. You have some extra money on the side. So just get into the lender's mind and the banker's mind right now. All right, they want you to have below at 25% or below. So what they're saying is, we want you to have enough money to pay us back. How can we give you some financing and you ain't got nothing on the side? You ain't got no extra money in the bank. You ain't got no cheddar. You ain't got no cheese. All you got is bills. Okay, so just think about it like that. They want to give you the money, but if they don't see a way of getting that money back, then they're not going to extend you no financing. And if you're over that 25%, that starts to spell out that you're over spending with the money that you have access to. Also with the back end. Okay, now typically what it boils down to is 25 and 25. Okay, 25% of what you're spending on your household and 25% of what you're spending on things outside of your household. Okay, now sometimes it can even go up to 30%, but for the most part it's 25. It's 25 and 25. You want to stay under 25% of what you're spending on the things that are in your house, and you want to stay under 25% of what you're spending on things that are outside of your house. Okay, there's a debt to income ratio calculator that we will be exposing you guys to. A lot of you have already had exposure to it from being in the Facebook group. I posted it on Facebook, and you guys know that there's also an article on my LinkedIn account that you can have access to it as well. All right, so let's talk about it a little bit. Good debt. All right, what would be a good debt income scenario? Okay, so let's break it down there. Okay, let's say a person makes $50,000 in income. Their rent is $700 a month. Their credit payments, what they pay back in the credit cards, is $100. Card $400. And then basically your amount is $1,200 each month. Okay, so when you calculate that on the calculator that we have already provided to you guys, and if you don't have access to it, we show the links to it on here, and we'll also give you guys access to it in the PDF that we're going to provide to you guys as well. Okay, basically when we add that up and we utilize the debt to income calculator, okay, you're at 17% on the front end and you're at 24% on the back end. And if you guys remember where you're supposed to be at when it's at your debt to income ratio, it's what? 25 and 25. Okay, so that's why this is a good debt to income scenario. You're under the 25% for your front end, which is 17, and you're also under the 25% on the back end, which is at 24. This is a great example. This is the type of person, as long as their credit is also up to par where they need to be with the other information that we provided to you guys in the first couple slides. This is a person that's a prime candidate for financing. This is the type of person, along with their good credit, they got great debt to income ratio. Bam, this is what ends up spelling out commissions to you guys when you're getting those checks. It ends up spelling out commissions to even us when we're getting checks, because we still have agents that are in Minnesota, and then we got people that come back to us from in the early days. So we got clients that are coming back to us that are in-house. All right. This would be a good scenario for a person to get financed. Now, let's take a look at bad debt. What would be a bad debt to income ratio? All right. This is basically the same kind of income, but a person is just overspending just a little bit, okay? And maybe, you know, just, you know, kind of not even a little bit on the back end. But now you got a person here that is making 50 grand, all right, as income a year. Their rent is $1,300 a month. Okay, car note is $600. They're paying $200 on credit cards, and then they got other little miscellaneous payments that boil down to about $100 a month. Okay, their debt to income ratio is 31% on the front and 53% on the back. Okay, I want you guys to take the calculator that we are providing to you guys. Click on the link, go there, come back, look at the presentation, and put in the exact same numbers. Put in the exact same numbers and see what it comes up with, and read the information that it gives back to you, so you can get information on why it even calculates it that way. Okay, this is something that will be great for you guys to do. Don't take my word for it. Do your own research, put in the exact same numbers, and see what you get, and start to really understand this stuff, because it's not just about financing. Okay, don't worry about that part. It's not just about financing. All right, you're getting great information. This information is going to help you make money, provide a better service to your clients. Okay, all that is great. That's what we're here for. But also remember, you need this information as well for you, for yourself, for your own financing, to know, all right, to know exactly what you have to do when it boils down to your own DTI, in order for you to cut back, for you to save more money, to look good to financiers, to provide this information to your children so they know exactly what to do when it's time for them to do financing for their projects that they want to do. And you know, I pray for everybody on here that they all have little entrepreneurs, you know, little him and her entrepreneurs that grow up to be great millionaires. And you know, hey, we're parents, so you know, come back, take care of mom and pop. You know, shoot, you know, we want you to pop up with a few presents every now and then. I'm just kidding. But anyway, this is information that you guys get to use for yourself as well. Okay, so this is the type of person that would get turned down. Okay, also, even if this type of person has a great score and great history, you're just leveraged out too much. You don't have nothing to pay these lenders back if they do want to provide some type of financing to you. Okay, to them, you're a risk. Or this is also what can happen. They'll be like, okay, you're maxed out a little bit, but we see that you've been on your job for such and such amount of time, and you have access to this amount of financing, and you can't be over leveraged a little bit. We can see that. Okay, you can pay us back the money that we're going to extend you, but guess what? Now the interest rate goes up. How does that calculate? How does them looking at me and seeing that I'm using a lot of my money to paying my bills and my debts every month calculate to them raising up the interest? Shouldn't they lower it because they know that I can't handle that much? No, wrong, sorry. You're a risk. Since you're a risk now, they want to get more money from you for taking that risk. Okay, so you can sometimes get financed if you're in this type of bad debt situation, what you're seeing on the screen. But this is one of them instances where the interest rate goes up and you got a good score. Okay, it's like, wow, I got a good score. My interest rate is that high. Yeah, buddy. What are you doing with the money that you're making every month? Okay, this is something that you can't hide. All right, so you don't have to have a low score to get a high interest rate. Okay, that's also a factor. It does happen. That is true. I'm pretty sure you've heard it before or on some commercials, but this is the other part that will get you a high interest rate as well. Okay, real quick, and I probably should have put this slide first, but it's all right. What is my debt to limit ratio used for? Okay, it's for the lenders. It's for the lenders. It's for the banks. They want to evaluate your debt load and see if you're actually a person that they can extend financing to. I've already explained that stuff to you guys. Okay, that's typically what it is. That's all it's used for. Can we provide financing to this person, and can he pay us back? All right. The last one, typically, this is what it spells out. A high debt equals less borrowing power. The more money you owe, or the more money you're spending out, the less money that you'll get access to. That's just the bottom line. Nobody wants to be the person left holding the bag. They don't. They don't want to be the person that's left and you done paid everybody else back. You done robbed Peter to pay Paul, but now Steve and Tony are just left hanging in the wind because they were the last ones to give you financing. All right? So that's typically what it's used for. It's just to evaluate you to see if you are a good risk or not. Okay. This is the links for the calculators that we utilize to be able to come up with those scenarios for you guys. It's a great calculator. It is very close to what it is that the lenders are using. I suggest that you take a look at it, learn how to operate it, especially if this is a business that you plan on being in for a while. It is a growing industry. It is a great industry to be in. It is not only a great industry for, like I'm always telling a lot of people, if you're into credit repair, learn this stuff because it goes hand in hand with credit repair. After people get their credit fixed, guess what they want? Financing, but they don't know how to get it. They think that because they got a great score, because they just got a couple items pulled off their credit, oh yeah, I'm gonna get a lot of money now. I mean, if I had a big red button to push so it can make that sound, I'd push it all day long every time somebody calls, you know. All right. This is going to be huge for anybody in the financial space, whether you're an accountant, even if you're in insurance, because guess what? Everybody needs money. If you're in the credit repair industry, after they get their credit fixed, they want money. If you're a consultant, guess what? People want money, so consult them about financing. If you are a financial planner, okay, we'll help plan out their finances and show them the correct way to be able to do what? Get money. Okay, so these are some calculators that you guys can use at your disposal. They're online. You know, you click on them anytime. If you got somebody that's asking questions, you know, it's like, hey, give me some information about what your financial situation is. Let's throw them into the calculator and let's see exactly where you stand. Okay, so you guys can copy these links, go back into the group later on, watch the video, write it down, click on them. They'll also be provided, like once again, in the PDF that I'm going to give you guys with some other very important information, so you guys will be able to find it there. Also at the bottom, you guys see my LinkedIn account. That's the exact same link that takes you to the same article that I posted a while ago. So these calculators have been there for a while for you guys to be able to use. For those that have used it, great, kudos to you. You're on your job. I appreciate you and I salute you for taking the initiative to be better than what you was yesterday when it comes to your knowledge in this industry. If you have not, well, here's another chance for you. Okay, like I said, they're here right now so you can see them later on, and also they'll be in the PDF. Okay, a lot of you guys have already seen this. Some of you have not, but it's good for you to see again because we've made a few changes, all right, when it boils down to it. We can, and we have the lenders that go as low as most of you know. We're advertising 560 scores, but guess what? This is the biggest problem. When we're advertising that, guess what we're getting? People that have less than 560 scores, or they're just right there at the 560, and they're like, well, hey, you guys advertise that you do 560 credit scores, I should get a lot of money. No, you shouldn't. And more than likely, no, you won't. That means that's the bare minimum. That's the edge. What do you know? Do you know what it means when you're on the edge? You're like just a snap of the fingers from going over it. That doesn't mean you're going to get a lot of money. Sorry, sir. Okay? So what we're doing now is we're trying to set a whole new standard, and we want you guys to set this standard with us because we want you to get paid. For those of you that are only getting a few $100s on your commissions, this is going to change it to where you're getting almost $1,000 on your commissions. And even when you get people with higher income, this is going to make the difference to where you're getting a couple thousand on your commissions because it is doable. We promote that because it's doable. It can be done. I've done it. The agents that we have in Minnesota on Seasoned Executive Solutions do it. It can be done, but you have to set your sights higher. So we're setting a new standard for you guys. Don't go after the people with the 560 credit scores. Go after the people with the 620 credit scores or better. Okay? These are people, not only do they got higher scores, but more than likely, they're just more responsible. And that's what we want. If they are more responsible with their credit, then guess what? They're probably going to make a little bit more money. And they probably got just a little bit better credit history on their file because their scores are a little bit better. And they do value their credit. And they do value what they do with their money, so their debt to income ratio isn't just sky high either. Okay? So when you start focusing on quality clients, which is what we're trying to push you guys towards, that's when you make more money. And you make a bigger difference, and you break into a whole new crowd. And when you get referrals from these people, they're going to come with those same type of scores and that same type of income. So guess what that means for you? More money, more commissions, higher commissions. Then you're doing bigger applications, and you're doing more applications, and you're doing greater volume, and then you're just getting a call from me or Bridget or someone else, maybe in Minnesota, because we might have them start making phone calls for us too, because the workload sometimes gets a little bit too much, and they just let you know, hey, we're upping your commission. You're doing great. Keep doing what you're doing, and make that money. And we'll talk about an even higher commission as long as you keep doing what you're doing. That's what it's going to boil down to. All right. So we're going after people with 620 credit scores. All right. The higher the score, the better. We're going after people with $40,000 a year in income or better. Okay. Also, you guys already know the negatives, such as bankruptcies, so on and so forth. They have to be at least 2 to 3 years old with positive information coming from behind it that they've been doing over the last few years since they had that negative, or just don't have no negatives at all. It's better if a person has just gotten finished with their credit repair and they've added positive information to boost their scores back up. Great. That type of person, he's ready to go. Let's finance it. All right. But that's not always the case. If they're a person that has negatives, at least 2 to 3 years old. Okay, you already know at least 4 accounts on their file. I like 5. 5 makes you look more favorable, but at least 4, because we're always saying 4 to 5. That's typically what you need, bare minimum, once again. But if you think about it, 5 or more is better, because we need what? For a perfect credit file, it's 20. If you guys remember, 20 accounts on your file. Okay. Also, no maxed out credit lines. This is something that we also run into. People think that because they got a nice credit score, or and sometimes their credit score isn't all that great. They think because they're in the low 600s that they got a great credit score. That's fair credit. You can look that up. You can Google it. Everybody knows that one. It's fair credit, not good credit. You got fair credit. Okay, and 9 times out of 10 you got fair credit because your other credit lines are maxed out. And guess what? If your credit lines are maxed out, nobody's going to give you no money, because what? We talked about it before. You need to show that you're at 30% or lower of your utilization. Once you start to get over 30%, then guess what? Nobody wants to start taking those risks on you, because you're using just too much of what you got access to. I didn't make the rules. I only know how to play the game. Okay? You need 3 months bank statements and 3 current pay stubs and W-2s or 1099 if they are asked for. Also, guys, remember this, okay? We can go lower than the banks, okay? We can, and we do. We are the alternative, and we do get a lot of business because we are the alternative. All right. The banks still want you to have a 680 score or better. For the banks, 680 is the bare minimum. You're at the cutting edge with them. If you're below a 680 and a bank gives you some money, then that means that your debt to income ratio has to be really, really low, and you're making a lot of money every year. So they're willing to take that chance on you. But for the most part, a 680 credit score or better is what's needed to get financing from the banks. We're still below the bank standard when we're looking for people with a 620. So don't think that, hell, we just went from 560 to 620. Jesus Christ. Okay, it's not that bad. I promise you. 620 is not that bad. There are more people with 620s than 680s. All right? So think about that. Also, real quick, some reasons why you can get denied. Okay, so put this down in your notes, add it to your repertoire. So when you're speaking to people and they're wondering about certain things, they're like, oh my God, why did I get denied? Or they're asking you some reasons why you can get denied. All right, this is also something that you need to have in mind. Okay. At all times, all right? If you just recently applied for credit and were denied, all right, it's not going to happen. You already got a denial from one company, and these people, they're going to look at your credit when we do the soft pull, but at the same time, they're also going to look at that big fat denial that you just got from someone else, and that's going to be like flashing in their face like, we don't even need to look at the rest of this stuff. He's already been denied from this place over here. Okay, that'll cause you problems. If you just recently applied and received new credit, and now they feel like your income can't sustain anymore, that's another reason for denial. Okay, if you don't have at least $25,000 in income, okay, that's typically the lowest it can go. All right, we already mentioned it in the other slide before that we're focusing on a person having at least 40,000 or better, because that's the target market that we really want to start focusing on, because those people will be able to get access to more money, because we want you guys to make more money. But that's typically what will happen if your income is and not at least $25,000. Then that's already an automatic denial. Okay, just think about how much money that is a month. I mean, that's really what just a little over $2,000 a month. Actually, even after taxes and all that, it's under $2,000 a month. And then you got your rent, and you got your car, and you got to eat, and you got so on and so forth. Okay, you can already add that up, and that's the same thing that the lenders are doing. They're adding it up. Like, this dude doesn't even have no money left. He's using it all just to live. Okay, that's why $25,000 is the bare minimum. All right, if you have too many inquiries from shopping around with other financing companies, denied. You're doing too much. You're trying to get too much happening. Okay, so that's typically what's going to happen to you. Now, if your credit is maxed out or over the utilization of 30%, guess what? Denied. Okay, we already spoke about that. If your documents do not match what you put on the application, denied. Okay, you're not submitting in your information what you said you had access to. All right, that's a red flag. All right, if you have any negatives on your credit, which is under 2 to 3 years old, guess what? We already know what happens to that. Denied. If you have not added positive information after those negatives, denied. Changing your address too many times, hey, sometimes you can get denied for it because you seem like you're unstable. All right, if anybody has been denied for that, then you can probably speak up on it a lot better than I can. But I've seen it in some applications when I was doing credit funding. You got addresses, you're switching addresses like every couple of months you got a new address. Nobody wants to deal with nobody like that. That's like you're trying to run from something, and I don't want you running when you owe me some money. Okay. Also, not enough time on your job. That could also equal to a denial. Just a couple last thoughts real quick before we wrap it up. Remember, there is no one size fits all when it comes to credit building. Okay? Everybody's situation is different. Some people have had credit and they just need a little push. Some people have never had credit and they got to start from the very beginning. And then you got the people that, are trapped after, a whole bunch of negatives, and they got to rebuild their credit, and credit has to, accounts have to come off, and then they got to put brand new trade lines on, and, and then also, age even plays a factor. Okay. A person that has great credit history and a great score and they're 30 years old is going to get access to more financing than a person that is 18 years old and he has a great score and he has access to a couple authorized users and maybe one or two cards or something. Okay, it's a different ball game. It's a different ball game. Okay, age will play a factor. All right. Also, protect your credit. Protect your credit. I can't even stress that enough. Protect it. Protect it. Okay? It's like your reputation. It's your life. It's the economy we live in. When you got bad credit, all you get is denials. You can't get certain apartments. You can't get the interest rates that you want. You can't get the financing that you need. I mean, it just spirals out of control. It's even starting to bleed over into the employment sector, where if your credit isn't up to par, the employer might not tell you, but they took a look at your credit and they saw that you're just delinquent on everything, and they're like, well, if he's delinquent with everything in his own personal finances, how is he not going to be delinquent on the job? Okay, that's what it spells out. That's what it does. So protect it at all costs. Okay, plan your funding methods. All right, you have to be strategic with this. It's a chess game. All right, it is a chess game. You can't just apply to 1,000 places in one day and then another 1,000 the next day, and you're like, why am I getting no money? You're not getting no money because you're everywhere. You're trying to get money from everyone. Okay, that's not how the game is played. That's not how it's played. You gotta properly plan this stuff. Fix your credit, build your credit. Get with a person that knows about funding so they can get you the maximum amount of money because they know how to maneuver. They know which lenders to go to, like us. We know what type of cards to get a person. If I was doing credit funding, that would be no problem, but we're just doing financing. But there's a certain method to the madness, and you have to know the strategy, or you're going to get more denials than you do get approvals. And if you do get a couple approvals, it's going to be for a few $100 on a card, or maybe even $1,000 or two, and you think that you just won. You think that you just got over. Hey, Capital One just gave me $1,500. I'm getting it. What do you mean? I did good. Man, stop it. Stop it. When I was doing credit card funding, we never did nothing less than 100 grand. Literally, nothing less than 100 grand. When we built a person's file out and we went in to get them financing, everybody cleared 100 grand or better. Some people got 150. Okay, it can be done with the right strategy. All right. Also, use your credit building accounts for nothing else other than building credit. Don't go hog wild with it just because you got it. Don't spend it up because you got it. Don't use it just because you got it. Use it just to build credit. Have an end goal in mind, which is get more money. Get money that you can really do something with. All right. Also, if you're just starting, okay, you want to shoot for those 5 accounts that we spoke about. You want to have at least 4 to 5 accounts. Okay, that is going to make the biggest difference when it comes to financing. Okay, at the very least, you want to have at least 3 revolving accounts and 1 installment account. Okay, what is an installment account? An installment account is a loan or an auto loan or a mortgage, something like that. And if you're just starting, of course, you're not going to get none of those type of things, but you can get like in a self-lender account, or you can get a secured loan from your bank. All right. Thank you, everybody. Thank you for joining us. I appreciate you all 100%. I hope you learned a lot because I gave out a lot of information. And if you are on the line, this is what I'm going to tell you guys. We're going to stop the recording in a second, and I want you guys to stay on the line and we'll be able to answer you guys' question. Until then, take care.